Hello, this is Dylan Moore with IRETA TV coming to you today. It is Wednesday, March 9th, 2022, and today I've got Nima Majur, who is also from IRETA TV. Nima, how's it going? Pretty
good.
Yeah, I'm doing excellent. I'm excited to talk about the thing that we got together to talk about, which is how to make some more money out of your money. So Nima is an advocate and a practitioner of what's called the permanent portfolio. And we wanted to do a show talking about this because we feel that it's going to be beneficial to anybody who listens to it. And particularly in the time that we're facing where inflation seems to be so run amok, it's important to have a tool at our disposal because your bank account sure isn't doing it at 0.25% or whatever the heck it is. A tool at your disposal to give you a return that at the very least can get you neck to neck with inflation and hopefully beyond that. So, Nima, can you start off by giving us a 30,000-foot view on what is the permanent portfolio and how'd you find it?
Mm-hmm. Yeah, the permanent portfolio is an investment portfolio that was created by Harry Browne, who was an investment advisor, radio talk show host, and also, I believe, one-time Libertarian Party presidential candidate in 2004 or so. And I invest my money, my core holdings that way. And I think it's a great portfolio for many reasons that we're going to be going through today. But just a big picture view is it's basically a very simple portfolio that's divided into 4 asset classes, 25% each, cash, gold, stocks, and bonds.
And then I think we were mentioning this before we hit the record button, that we also want to take a look at macroeconomic trends and how these affect the permanent portfolio, and
exactly,
and really how it explains why the permanent portfolio is such an effective way to have a consistent way of having your money go up, regardless of what's dipping or spiking or whatever the heck else is going on.
Exactly. The permanent portfolio will help you understand, if you understand the permanent portfolio and what drives it, it gives you a perfect or bird's eye view of the entire macroeconomy and which macroeconomic factors affect which assets in the portfolio in what way. So I think we can just get started with...
Yeah, we might as well just jump into the 4.
Mm-hmm. Yeah, the four
corners of the earth that you just brought up, or the 4 corners of the economy.
So the 4 assets. So, like I said, 25% each, and 15 and 35% rebalancing bands, which means that if any asset drops below 15% or grows above 35% of the overall asset portfolio, you rebalance the entire portfolio. You sell the leading assets and you buy the lagging assets to restore that 25% balance. So the first 25% is stocks, and specifically not one particular company's stock or not a stock list that you
personally have. I like these stocks. We're not talking about those.
Exactly.
Yeah.
But it's rather you buy an index fund that represents all stocks in your country, cap weighted, which would mean in the case of the US, for example, you buy an index fund that represents the entire stock market. What I do is I buy the S&P total stock market index. It's a little better than the S&P 500 in my opinion, because it's more expansive. It includes more assets, and in particular, it includes more risk assets. So when the economy does well, when it's time for the stocks to be the main driving force of your portfolio, you want to have an asset that you want to have a stock asset allocation that's growth oriented and not conservative. Because for the conservative stuff, we have other sections of the portfolio.
Right. So the stock is like the aggressive of the 4.
Stock is the aggressive, and Harry Browne even at one point mentioned, I think in his book, Fail-Safe Investing, which we'll link to as well, which is where he basically first introduced his portfolio. He says that you want to buy more volatile, growth-oriented funds, but actually the S&P total, S&P 500, due to the nature of the U.S. economy, which is largely tech and all that, is actually a great aggressive stock position already. So you don't really need to worry much. You don't need to think much about it. You don't need to be an expert to buy an S&P 500 total index fund. And obviously, so going back to the macroeconomic factors, when do stocks do well in the economy? They do well when corporate profits rise and when the risk-free rate remains behind profit growth. Because
and asterisk on risk-free rate, because someone like me, when you first talked to me about this, wasn't sure what that meant. So not that you have to explain it right now, but I do want to catch that and say we'll be explaining what the risk-free rate is.
Yes, we'll get there, yeah. But stock valuation 101 is basically, let's say you want to evaluate an individual company, you take all the expected future cash flows of the company and you discount them by the risk-free rate, and it gives you a present value of all of those future cash flows, which is in finance, it's called a net present value calculation. And if you apply that to the entire stock market, obviously, if corporate profits overall are soaring and the risk-free rate sort of remains, lags behind the profit growth, then you'll have rising stock prices. And then this particular asset allocation will do well. So that's during times of economic boom, specifically, this sector of the portfolio will do very well. It won't do well when you have a depression or a recession, because that's when profit expectations collapse, etc. So the value of this particular allocation will go down, but there will be other assets in the portfolio that will make up for it and then some.
Well, and it actually turns out to be a benefit once we understand the whole picture, right?
Of course.
Yeah,
for sure.
Because you got to buy something cheaply in order for it to go up.
Right. Yep. So that's where the rebalancing comes into play. You know, if your stocks crash and the stock allocation, say, drops below 15%, and you have other assets outshining your stock allocation, then if you hit the rebalancing bands, then you get to buy stocks very cheaply.
When your other asset was worth more.
When your other assets were doing great. So that's another great thing that the portfolio does. It tends to force you to buy low and sell high. And it particularly does it at the moments when you instinctively or intuitively least feel like doing that thing.
That's an interesting point to point out. Like, oh, the stock market's bad, I don't want to touch it, when literally that's supposed to be the time that you're supposed to buy it. Yeah.
Exactly. And that's because the portfolio forces you to make counterintuitive decisions in these turbulent times. You know, when stocks crash, when gold is going up and up and up. Oh my God, I love my gold so much. And stocks, nobody wants stocks. They all suck. That's exactly when the portfolio tells you to sell gold and buy stocks. And you can go back and listen to other people who invested using this portfolio. A lot of them talk about how they just absolutely hated rebalancing, but then at the end of the day, it always turned out to be a beneficial decision for them financially. In my case, I so far haven't had to rebalance yet. So, you know, I've had this portfolio since 2015.
You haven't rebalanced in 7 years?
Because I haven't hit the rebalancing bands in that whole time. And that's another good thing, you know, because ideally you want to have as few of these rebalancing events as possible because of tax liabilities that come due when you realize capital gains. You know, so I haven't had to rebalance yet. I may have to one day, but it hasn't come to that yet. It was close, you know, when in April 2020, when the COVID crash happened and stocks crashed and Treasury bonds rallied and gold started rallying, I came close to having to rebalance, but it just didn't hit the bands. So we stayed within them and so there was no capital gains events or anything.
Mm-hmm. So what's the second?
Yeah. So the second is and just to go back to stocks and corporate profits, I just want to talk about what drives corporate profits.
The macroeconomic aspect.
Yeah, macroeconomic factor. There's an equation that was created by an economist. His name was Kalecki. It's called the Kalecki equation, and it tells you that corporate profits, that aggregate corporate profits, are the sum of investment spending, budget deficits, export surpluses, consumption out of profits by the capital owners, and minus household savings. This is the Kalecki equation. So you can see, government budget deficits help corporate profits. Investment spending is a net positive in corporate profits, and export surpluses as well. This was what helped MMT-minded investors like ourselves and Mike Norman and people. This is what helped us predict the incredible stock market boom of 2020 and 2021, which is after all this
COVID money. Because the budget deficit was going up, that money had to go somewhere, right?
Exactly.
Yep.
The money had to go somewhere and ended up in corporate bank accounts. It's not even something you need a PhD in economics for to understand. What? Tim Cook of Apple, he said himself, after Apple reported great earnings in 2020, I think already, he said, what has helped us have been the economic impact payments to individuals. In other words, the stimmy checks, because people are still able to go and buy their iPhones, buy their chargers and their cases, their accessories.
Well, and
Apple being one of the largest companies, in the country, a lot of that money flowed right to them, basically.
So just to demystify that equation, in case someone's not either mathematically or economically inclined and they just glazed over when you said it, I think an easy way to think about it is just imagine a bathtub and we're either pouring water into it or we're pulling water out, right? Well, if the government's spending more money, it's pouring more water into the economic bathtub, right? If people are saving money, meaning they're putting in their bank account and they're not doing anything with it, that's pulling money, not out of the economic bathtub, but out of the corporate profit bathtub, right? That's money that's not being spent on the iPhone that's going to Apple.
Exactly.
Right.
Exactly.
Right. And there was a couple other things in there, like if there's money coming in from exports, that goes toward it too, and stuff like that.
Exactly.
But
the only one that's maybe a little, because it's inside money, not outside money, is investment spending. Why does investment spending drive corporate profits? Because if you think about a very primitive economy that's just hand to mouth, everyone just, plucks turnips out of the ground and eats them. You have no profits, no surplus accumulating. It's just constant production, instant consumption. But if you say invest in machinery, then you conduct what's called in economic terms investment spending, because you're buying things that are not
immediately
consumed. They end up, and it takes a couple of macroeconomic equations to go through, which I don't want to do right now. But you end up with, if you have an economy with a balanced government budget and balanced trade, you end up with an equation that says the sum total of corporate profits basically equals investment spending.
Minus savings.
Yeah. So, let's say we have no household savings either. Let's say we have none of those things. You can start from a very simplistic equation that says your investment spending equals aggregate corporate profits, which means, some may lose, some may gain, but in aggregate, the entire corporate profit, the corporate sector gains this much.
To the exact amount that was put in through investment.
Yes.
That makes sense. Okay. Second, let's move on to the second asset.
yeah, second asset is Treasury bonds. So basically 25% goes to buying Treasury bonds. And what that means is you buy the longest available government bonds in your country.
And by US, longest, you mean you want the 10-year note, not the 1-year note, for example.
Yeah, or in the US, I want the 30-year note, not the 10-year note or the 1-year note. No. So you buy 30-year treasuries and you sell and you renew them every 5 years or so. So you sell them off after 5 years and then you rebuy the latest, newest treasury bonds available. If they come up with 40-year bonds, then I would reallocate. I would sell my 30s and buy 40-year, whatever the longest available government bond in your country is. I think Japan has 50-year bonds at this point, and I think they pay maybe 0.01% or so.
At least they're not negative. More. Yeah.
Yeah, right. Maybe more than that, but I'm just exaggerating. So when do treasury bonds do? First of all, what is a treasury bond? Okay, treasury bond is a savings account given to you by the federal government. So if we want to talk MMT terminology, when the government deficit spends surpluses into the private sector, or rather, okay, it's called deficit on the federal level, but for the private sector, it's a surplus. Then the government offers the private sector a way to earn interest through different bonds, 10-year, 30-year, 1 year. So the 30-year bond does well when we have depression or recession, when the stock market crashes, when flight to safety is on, basically, when people get out of stocks or even get out of risk assets in general, and they buy 30-year treasury bonds. The longer the duration, the more they will rally during such an event.
Well, and I think it's also important to point out is that there's I don't know if traditional is the right word, but there's a view that treasury bonds fund the government. The government sells treasury bonds in order to raise money for taxes.
Right.
Well, we go into much more detail about this in our previous MMT shows, and I recommend checking those out. But we do want to emphasize that treasury bonds are basically free money. It's a free interest rate from the government. Yeah. And that there's no constraint on the government's ability to pay back on those bonds. They don't need to sell more bonds or raise more taxes to do that. Literally, all they're doing is they're marking up numbers. Yes, I hear you screaming inflation, but again, please go back and listen to the MMT shows where we talk about that. So it's a safe haven because the only reason they wouldn't get paid is if the government made a political choice not to do it. There's no economic constraint on not paying them. So they're a super duper, they're like the most solid place to stick your money.
Yes, very, very safe investment. There's no default risk, unlike all other bonds, which is why there's other contemporary investment commentators like Colin Roche who talk about how useless corporate bonds are, basically. It's because corporate bonds, he calls them, they're like stocks and drag or something. Because why would you do that? You have your stock portfolio to benefit from the corporate sector. You have your treasury bonds as a hedge against undesirable events. And of course, you have a safe dividend for decades to come, which is the interest. And what drives the treasury bond interest? Well, it's policy, basically. But we know that the policy is driven by inflation expectations. So because the government thinks that when inflation is high and they raise interest rates, that is fighting inflation. Of course, we've discussed on here that the opposite is the case, that raising rates actually causes more inflation.
Because it's introducing more money into the system.
Exactly. The net inflow of money into the private sector goes up when rates are raised because whatever borrowers pay in increased interest, savers earn in increased interest. That's how the banking system works. So in the private sector, increased borrowing costs are offset by by rising savings income. However, what remains on the net is all the interest that flows into the private sector through treasury securities. So whenever you raise interest rates, you're always raising the net. It's like we've said before, it's like a basic income for the rich.
Right.
Or as Warren Mosler says, a basic income for people who already have money.
Well, and then going back to what you're saying about the risk-free rate, this is the risk-free rate, right?
Correct. The Treasury bond rate is a risk-free rate.
So, exactly. And just to go back to what you're saying about valuing corporate income, earnings, valuation, whatever it was.
Right.
When you're saying we're discounting the risk-free rate, you're looking at the fact that, okay, if I wanted, what's the minimum amount of money I can make, or I should say, the maximum amount of money I can make with zero risk. Okay, it's this Treasury bond. Let's say the Treasury bond's paying 3%, just for the sake of argument. Is you're saying, okay, if I have 100% no risk at 3%, why would I ever take a risk at 3%? Right?
Exactly.
That's why you remove whatever the risk-free rate is to make that determination on that valuation. Right?
Correct.
Yeah. Okay.
Right. You want to evaluate the risk asset in terms of its outperformance of the risk-free options that are given to every idiot in your economy.
Right. Right.
So that's basically that's how stocks are valued. That's what discounted cash flow analysis is all about. Stocks are always valued based on profitability expectations, the risk-free rate, and the risk profile of the particular business that we're in.
Mm-hmm.
Or the risk profile based on the management of a particular company. So, there's business risk, there's industry risk, and then there's macro risk. Mm-hmm. There's default, all these things. But with the Treasury bond, you have none of these. You get at the moment you get 2.3% guaranteed for 30 years at no risk, at no default risk. Okay, and people will say, well, there's inflation. Yeah, but no default risk. Okay.
Mm-hmm.
And we get to the inflation because we have other assets in the portfolio to take care of that.
And so, I don't know if you're about to move on to the next asset, but so for the stocks, we said stocks were driven by corporate bonds. And in good economic times, the stocks go up. In bad economic times, stocks go down. For the Treasury bonds, talk a little bit about what situation these are good in.
Yeah, Treasury bonds do very well during depression and economic crisis, financial stress, cash crunches. Anytime the economy takes a hit, and when I say the economy, I mean specifically corporate profits. And that's, by the way, when people talk out there about the economy, what they really mean is the aggregate corporate profits in your country.
I think you gave all the socialists a wet dream. We told you that. Yeah.
Of course, then people are employed, people get paid out of a portion of the revenue, but what remains to the stockholders, what the stockholders care about is the profits that remain to them or to their company.
Mm-hmm.
And so when the macro factors come about that lead to a decline in corporate profits, and we just talked about, okay, the Kalecki equation says budget, government deficit, export surplus, investment spending, household savings. When any of these factors change unfavorably, then corporate profits grow more slowly or even start declining. Mm-hmm. And that's the time when people who hold stocks get out of those stocks because
they're going down. Yeah.
The profits that were expected are not materializing.
Mm-hmm.
So the valuation has to be adjusted accordingly to what the new profit expectations are.
Yep.
And so during that time, the flight to safety is on. People buy Treasury bonds, and the 30-year Treasury bond rate in the U.S. and in almost all capitalist countries is determined by the market's expectations of the central bank policy.
Mm-hmm.
Because technically speaking, a 30-year bond is nothing but a bet that the average of all the
1-year bonds or whatever
interest rates within that period will remain below that level. So right now, for example, when I'm buying a 30-year Treasury bond at 2.3%, my calculation or my speculation is that over the next 30 years, the average short-term interest rate, which is determined 100% by the Fed, will be somewhere below 2.3%.
Mm-hmm.
Could be going up to 5% next year, but then going down to 1% the other year. But on average, sort of the expectation is 2.3% or so. That's because the federal government doesn't explicitly set the rate paid for 30-year treasuries. They let the market determine that whenever they have an auction. Mm-hmm. They sell them to the private sector. They could just say this is the rate. Okay, this is the 30-year rate and doesn't change. But that's not what they do. That's, by the way, what they started doing supposedly in Japan. It's a policy called yield curve control, where the government just starts outright decreeing, this is the 30-year rate, this is the so-and-so year rate. But the way it currently works in the US is we have the Fed setting the overnight rate, which is very closely tied to the 1-year rate and the 3-month rate. And we have the 30-year rate, which reflects expectations of where the short-term rate is going. This is why we sometimes have a situation where, for example, we may have a short-term rate that is higher. We may have a 1-year rate that's higher than the 30-year rate. Mm-hmm. So it's happened before. It usually happens before a recession, that the 1-year rate, say, for example, goes up to 5%, and the 30-year rate stays at 2.3%. Some people say, well, why is that? Why do I get rewarded more for my 1-year investment versus my 30-year? Well, it's because the people buying 30-year bonds are expecting the short-term rates to come back down to way below that level.
Mm-hmm. So they have a poor outlook beyond 1 year, is what you're saying.
Yes.
Yeah.
Yes. So then when you roll over, because if you only have a 1-year bond, you have to reinvest the next year. But if the rate has dropped to 0.5% the next year, then now your 30-year bond suddenly looks better. You know? So the 30-year bond is the idea of locking in a certain rate, and it reflects expectations of Federal Reserve policy of short-term rates. And it reflects something that's called the dot plot chart, which you can look up every day on the Federal Reserve or on the Chicago Mercantile Exchange website even. You can look up the investors' expectations of when the Federal Reserve is going to raise short-term rates and by how much. And when those expectations change, that's when the 30-year rate also changes along with
and then would it make sense to compare it to a mortgage with or without an adjustable rate? Like if I got a mortgage for 30 years without an adjustable rate, I know it's 5% or whatever for those 30 years.
Exactly.
If I get it at an adjustable rate, I guess typically that means that it just shoots up really high once it's over. But theoretically, it could go down, right?
Sure, exactly. Yeah. So it's like that, just in reverse, because with the mortgage, you're paying them money, but with the Treasury bond, you earn money.
Right.
But yeah, it's like you're locking in a certain return, and you have an asset that performs very well during economic calamities, depressions, recessions. Also, I would say during the Great Recession, at least, treasuries and people always think, oh, treasury is a conservative investment. Well, during these times, these kinds of assets will rally double, maybe even triple digits.
Yeah,
you can go up 50%, maybe even 100%. Like if the interest rate were to, even if the rates are very low now, 2.3%, but if the rate were to drop to 1% or 0.5%, you can expect some, 50%, 75% increase on your treasury bonds very quickly. Mm-hmm. During these kinds of crises, this can happen very quickly.
So far we've talked about two assets. The stocks, they go up in a boom, they go down in a depression. We've got the the bonds that do the opposite, right?
Mm-hmm. Exactly.
I think, are we ready for asset number 3?
Mm-hmm. Asset number 3 is gold. Gold is very interesting because it is, if I'm not mistaken, I think gold is completely uncorrelated to the previous 2 assets. Or maybe there's a minor correlation, but it's enough of it does its own thing to where it does what you need it to do in the portfolio. So when does gold do well? Gold does well when real interest rates are low. People always say, gold does well when inflation is high. And that can be true, but only if real interest rates go down during that inflation. And what are real interest rates?
I was just about to ask.
Real interest rates is the current risk-free rate. Let's say that the rate on 30-year treasuries is I think is a pretty good one to look at, to always take into account for risk-free rate. You can also look at a 20-year, 10-year, but I think the 30 years is probably just fine to look at. So real interest rates is the nominal interest rate that you get paid on these bonds minus the expected inflation over that same period. So this shows you, right? If interest rates stay the same, but inflation shoots up, then gold will go up.
Wait. So I blacked out. I don't know if I blacked out or if it was just confusing. Can we go over that again? So we have. Tell me what a real interest rate is again.
Yeah, real interest rate is the nominal interest rate minus inflation expectations.
Okay, so if the nominal interest rate on my 30-year bond is 5%, just for an easy number, and we were to expect inflation to be 5% a year, does that mean the real interest rate is 0 or it's some other calculation? It's 0. Okay. Yep.
That's exactly it. So this would be a scenario you're describing where gold would be doing pretty well. And if inflation goes up and rates stay like that, then gold will go up even more.
So that would be a case where the real interest rate is negative, right? Inflation's at 10%, but the nominal interest rate is 5%.
Which arguably
is what's happening right now, right?
we are in that kind of situation right now, arguably. Or what could also happen is nothing changes to inflation expectations, but nominal interest rates are reduced by Federal Reserve policy,
which has also happened very recently.
That also reduces real interest rates. So I will put it in the show notes if I find it. But there's been several people, one in particular I found, that have run a correlation analysis of gold versus real interest rates. And it's the best correlation I've ever seen anyone make the case for. People always have the theories about gold. It does well during inflation. It does well during crises and wars, which it does. I will get to that also shortly. But the one figure that I found the most correlation with is real interest rates. And that doesn't always mean that it has to be inflation. It could just be interest rates being cut drastically. And we've seen that during 2008, the 2008 crisis, Fed started slashing rates, and gold started rallying. We also saw it in April 2020, where after initial deleveraging and de-risking in general, gold started rallying to new all-time high, over $2,000. And we're also kind of starting to see something like that right now, although it's also another factor that drives gold is general economic uncertainty and war and
what's called potential political destabilization. How about that?
Political destabilization and any situation where the existing standards no longer work, or for example, Russian people thought that they could use their bank account to buy things in other countries, but suddenly that's not the case anymore. So what if the entire global financial system breaks down? All countries pull out of the Bank of International Settlement system and these kinds of things, and a new monetary order has to be reestablished.
Well, gold will probably be doing really good while all that's figuring itself out.
And especially because gold would probably then be the de facto money for a little while. And the new monetary order will probably be based on current gold allocations around the world. So gold is kind of like the money, the universal money, if you will, that hovers above all other monies. Doesn't mean, like, we don't believe that gold makes for a good medium of exchange. We don't believe in the barter theory of money. We've talked about that in several shows now. But that's, of course, in an economy with a functioning system. But if everything breaks down, then there's still gold, and you can still weigh gold on your own, on your scale.
Well, and then I think it may also be worth pointing out that we're talking like between country and country, not within country, right? Because within the country, yes, you still have, I mean, even if it's breaking down between countries, you still have access to your own money system within the country.
Well, yeah. Unless the country's money system also collapses. Then it's even stronger case for gold. The gold will help you in those situations. Guns will probably also help you in that situation.
And food.
Otherwise, how do you protect your gold otherwise? But the important factor, gold does well when real interest rates are low, which happens when inflations are high. Plus this magic factor X, which I can't quantify, which nobody can quantify, but it's some sort of crisis sentiment, some sort of panic scenario. We saw it with COVID, we see it with Ukraine crisis, we saw it in 2008. We see it whenever people get incredibly nervous.
There's a psychological urge that we all have, whether it's innate or just culture that we've accumulated over the aeons, is that we know that that's for some reason a safe place to go when things are going crazy.
Absolutely. Yeah, that's a good point. It is a good point. We've had all kinds of sovereign money systems appear and disappear over the millennia, but we still have gold. They used to worship gold back in the Sumerian days and the Mesopotamian days and the Egyptian
and the ancient Greek days too. I mean, there was a very strong correlation between the religious authority and their need for gold.
Absolutely, absolutely, and that's.
I wonder if that's where it comes from. Honestly, our obsession with it.
No, because that's another thing. Gold was very popular as temple sacrifice, and it's kind of like in MMT parlance. We look at why does the government money have value? Well, because the government demands it in taxes. Back in the day, you had temples demanding their donations in gold, or the sacrifice or whatever. And Robert Kiyosaki said this one. He said, fiat money is the government's money and gold is God's money. Okay. So there's obviously a lot of people who look at it that way, and who knows if that's the reason why gold does well whenever things go haywire. But definitely an asset that will give you a kick to your portfolio that you need in certain times, that you need when things go crazy, and that you need in order to stay calm about your other assets in the portfolio, which won't be doing very well necessarily. If inflation goes up significantly, then as we know, oftentimes the Fed raises interest rates when inflation goes up beyond expectations. But when the Fed raises interest rates, that's not very good for your Treasury bonds. They will probably start going down, but the gold will go up as long as the inflation outpaces the rise in interest rates. We had a situation, I think, in 1981 or so, where interest rates went up to something like 18%, and gold had hit its, at the time, I think all-time high around $800 or so.
Mm-hmm.
And it just started declining from then all the way through 2002, I think.
Wait a minute. Now I got to ask. So, nominal interest rate minus inflation. So when the real So when the real interest rates are low, gold does better. So
yes.
and the real interest rate is the nominal interest rate minus inflation. So I'm just confused here. So you're saying that when the nominal interest rate has gone up, for example, the early 80s, it went to 18%. Gold did better. Is that because inflation was outpacing that?
For a while. So throughout the 70s is when gold started rising, all the way up to I think to 81. It went up, and during that time, interest rates were continuously raised over and over throughout the 70s in order to fight the inflation.
I see. I think I get
interest
it.
Rates, yeah.
So the interest rate finally caught up to what was going on, which would be the thing that raised the real interest rate high enough that gold stopped going up.
Right. At one point, interest rates were just so high, you could make something like 18% on your savings account. And that is a deterrent for people, especially when inflation starts coming down, which started happening, I think.
Oh, that's interesting. I'm making so much money in my savings account, I'm going to pull it out of the gold and stick it in my savings account.
Absolutely.
Yeah.
Absolutely. That's what goes on.
Yeah.
And that's why also when there's barely any money to be made in your savings account, there's one less deterrent for you to go into gold.
Mm-hmm.
But if you make a lot of money in your savings account, then it's a huge deterrent from going into gold. And so throughout the 70s, we saw this crazy inflation, which was due to the OPEC shock, that was high enough to propel gold higher and higher, even though rates were going up and up and up. But at one point in 81, the rates were so high
that it finally caught up.
Inflation also started coming down because the U.S. started deregulating natural gas, and that started bringing the price of natural gas, and with that, the oil price down. The 70s inflation was over, and gold wasn't really that interesting anymore to people at that point. And that's when it started. It's a long decline for 20 years. It went down from something like 800 to something like 200, I think.
Mm-hmm.
And it only started rising again with when the 9/11 attacks happened. Interest rates were slashed, and at the time
2008
war.
Yeah.
Mm-hmm. Well, then 2008 exactly. So all these periods of very low interest rates have propelled gold
with very
higher.
much political instability.
That too, off and on, yeah. The only thing that hasn't made it go completely gangbusters is that inflation has been pretty tame throughout the 2000s, all the way through. Now, this is the first time that we're seeing, and I think we've discussed this on our show. We've predicted. We've probably predicted that inflation is going to start going up as early as April 2020, when we started seeing the kinds of government deficits that we're going to start incurring. So this is the first time in a long time that we started seeing inflation, the kinds of inflation rates that we're seeing now, even though they're oftentimes exaggerated because people always look at commodity prices like lumber that had gone up like crazy due to supply chain issues and stuff.
Right.
But we have certainly seen elevated inflation levels throughout the 2020, 2021, and now also. It's the talk of the town, right? Everyone's talking about inflation. So clear there's something going on, and that is helping gold, I think. And I honestly would have expected gold to do much better than it has been doing over the past year or 2 years or so, just because of the high inflation and the rates remaining pretty low. Now they've started discussing raising rates. And I think that this correlation between gold and real interest rates has been kind of broken with the advent of cryptocurrency. I haven't really.
Oh, that's an interesting point. Because
I want
to add to that, because a lot of people will jump to say Bitcoin when they see the instability. And I guess that's eating up a lot of money that would have otherwise jumped to gold.
Yes, I think so. And I think it's certainly possible because the crypto market cap has now reached levels to where it's starting to compete in it's not nowhere near where gold is. I think the gold market cap of the world is something like $10 trillion or $9 trillion, something like that. But crypto is now, Bitcoin is, I think it's 700 billion. Overall, crypto is maybe $1 trillion or maybe 2 trillion. So it's getting into that same ballpark.
Yeah.
So it's become an alternative for people. And that, I think that's a possible theory as to why this link has been broken. And I also think that might be a reason for gold to rally a lot over the coming years. I mean, a lot, kind of like the kind of rallies in gold that we've seen in 2002, when it went from 200 to 1,000 to 2,000. I think
so. You see the gold rallying due to what reason with the cryptocurrency?
Because I think people have been using cryptocurrency as, to some extent, investors have been using cryptocurrency as a substitute for gold. And all the more so, the more the total market cap of crypto has been going up. I think a case can be made that has been happening, but I don't think that that's necessarily valid. And I think that there could be a day of reckoning at some point where crypto investors realize that crypto is not really the safe haven they hoped it would be, and where gold will once again
get its title back.
Take back the safe haven status that it's had for thousands of years already. So I think that's a possibility. I'm not saying that it'll necessarily go hand in hand with a crypto crash, but
I think there is a point to be made that people now have a second option, at least that they think they do, of saying, okay, there's this political instability. I'm worried about the dollar. I'm worried about the ruble. I'm worried about the euro, whatever. Instead of immediately running to gold, I could imagine it's even more speculative, saying, okay, I know if I go to gold, then I'll be good, but I'm not going to get rich. I could get rich if I jump to Bitcoin. Yeah.
And these are so. This is the dream scenario for gold, in my opinion, right? We have higher inflation than we've seen in a long time. We have lower interest rates than we've seen in a long time. And we have political instability, et cetera, et cetera. And we've had a potential suppression of interest in gold due to cryptocurrency, and gold has become a very boring asset again. That's a dream. These are all great factors for gold to do well, in my opinion. Not investment advice or anything. I'm just saying, I think it's very well possible that gold will surprise significantly on the upside. And one of the reasons being because it's been so boring for so long. It's been disappointing people for so long.
Especially Peter Schiff.
Yeah.
He will get his day of reckoning, I believe Nima is saying.
Yes, I think I think that's possible, and I'm not a gold bug like Peter Schiff. I'm pretty agnostic to stocks may do well, but I'm just saying things look very good for gold overall, I would say.
Well, is this a good time to jump into the fourth and final asset?
Yeah, the fourth and final asset, which is pretty boring, is cash. And Harry Browne recommends just 1-year Treasury bills. What I do on Fidelity, I buy Treasury bills at no fee, and I use a feature called Auto Roll, where at the end of the year, it automatically sells that Treasury bill. You get the profits, and it invests the same in the same kind of Treasury bill again. So you don't need to do anything; it just keeps rolling over.
And then you do that because it's the risk-free rate, where you're like, well, if I'm going to have this pile of cash sitting here, I might as well get whatever the heck the Federal Reserve is going to pay me on it, 3% or whatever it is.
And I think the Treasury bond, the 1-year Treasury bills are actually safer than cash. It's safer than cash on the mattress. There's no FDIC. There's no bank risk.
Oh yeah, so like if the bank goes out of business and like, well, yeah, you had more than $250,000 in your savings account. Sorry, there's none of that.
So that's the problem. If you have more than that, then you don't have FDIC protection. So that's where with Treasury bills, you can have unlimited amounts in it, and you don't need FDIC insurance. You have it right from the federal government. They create the money that they pay you. So they create the money to pay the interest. They create the money to pay the principal. So it's as good as cash. Some people say, I would say it's actually better than cash. And
so what?
That's just the fourth asset, but also what this asset.
What's it do?
When you you earn the short-term interest rate, which, by the way, there are certain times when this rate goes quite high. Like for example, I think in 2006 or 2007, right before the 2008 crash, the short-term rate was somewhere around 6% or 6.5%, 7% or so. Like I said, in the early, 1980, it was 18% or so. So oftentimes, whenever the rates have gone this high, sooner or later, you're probably going to see some sort of recession. So your stocks will start suffering a little bit and those things. So then the cash will still earn a pretty good return. I mean, it's not a bad return to give you 6% on your cash. And also, when your other assets fall and decline, your stocks or your gold goes down, your cash is available for rebalancing and for buying low whenever those assets have gone down. And by the way, you have some cash that you can always fall back on when times get rough. When, let's say, you get laid off or you don't have business isn't very good right now, then you always have a good cash portion in this portfolio that can sort of help you pay your bills.
So would it be safe to say something like this, which is it's kind of the liquid that makes all the other pieces work?
Yeah.
Yeah.
It's the lifeblood of the economy.
I mean, of the permanent portfolio, I'm speaking specifically of, because my initial reaction is to say, okay, here's this cash. If it's not making as much money, why not just throw it into the, split it between the other three? What's the unique function that it's doing that's helping with the balancing act?
Number one is that purely empirical analysis. It shows you that a portfolio, if you back test it for 50 years or so, the portfolio with the fourfold allocation, and one of them being cash, performs better than the threefold portfolio that you just proposed. Because otherwise, maybe it works better to put it all in these assets. But no, the cash allocation helps you in times when stocks come down, other assets come down, to rebuy at low levels with a lot of the cash that you have sitting in the portfolio.
Well, and then, like you said, also there's the short-term bonds where, there is a chance that, the short-term jumps and you're like, wow, I just got 5% for nothing.
Yes. So this is a factor that will absolutely occur from time to time in the economy. You'll have high interest rates, and you'd be losing out in those moments. You'd be losing on the stocks that you've put your money in instead of cash. You'd be losing on the bonds when they come down, or on the gold when they come down. That you wouldn't have lost had you had a portion in cash. And I mean, also, by the way, again, if you don't have a cash position in your portfolio, you don't have a rainy day fund for yourself.
Right.
You rely on all those three assets always doing good, and they might not always. During a recession, there's actually times when the other three assets will come down: gold, bonds, and stocks, and that's when it helps to have a little bit of cash buffer.
Well, and then if we're talking
Zero.
about the balancing act, if you do go past one of those bands, you go, okay, now's the time to take that cash and buy the other stuff because they're low.
Exactly.
Yeah.
Exactly.
So that when you first told me this idea, I found it fascinating for the reason that you brought up already, which is there's this auto balancing act that forces you to make the good decision, which is actually counterintuitive.
Mm-hmm.
Right?
Exactly.
And so we have these economic forces at play, and we talked about the different economic forces for each one of these four, cash being kind of boring one. But whatever the economy's doing, if this one's, even if, like you said, all these other three go down, this one still remains neutral. The cash still remains neutral, so you still have the balancing act going where, okay, this one went down, flush the money over here. Okay, this one went up, flush the money over there. And why it's designed where when all this flushing happens, you're still flushing up.
Absolutely,
right?
absolutely.
Yeah.
The net gain is positive, and over time, if you backtest this portfolio over 50 years or so, people have come up with an average annual rate of something like 9%. 9.5, 9%,
which is pretty good for a secure investment.
It's very good for the incredible safety, the stability, the stable growth that you get with this portfolio, the psychological calm that you get with this portfolio, and also just not just thinking about profits and gains, but asset allocation and geographical diversification. And I'm not talking about buying stocks from the US and Russia. I'm talking about where are your damn assets positioned? Because people are so used to having all their money on a trading account in the form of digital numbers that they look at when they log in.
Yep.
But the gold portion forces you to actually
have
make
some gold
a
at home,
more effort, and actually have some physical gold. Can be at home in the safe, can be at a safe deposit box in the bank. But what's important is that you have control over this thing. You can hold it in your hand. That's something that I think we've been trained to lose sight of, the importance of that, because things can go so crazy where it means a lot to be able to hold something in your hand. If you remember during April of 2020, when the lockdowns began, there was a time when you couldn't actually buy physical gold at anywhere. There's all this sellers were out. You could pre-order, or you could add to your wish list on appmex.com, these gold dealers, but they were generally out of gold. Even though the price hadn't gone up like crazy, they just weren't selling it. You just had to wait. You had to get in line and wait. So those are the times when let's say this becomes prolonged, because this was only maybe for a month or so. But if this becomes prolonged, it becomes harder and harder to get gold. You're looking really good with your physical gold, that you can hold in your hands, liquidate whenever you want to, whenever you need to.
Well, and then there's something else to add to that. Imagine we're in the Soviet Socialist Republic of Canada, and the Prime Minister decides that he's just going to ban your bank account and prevent you from accessing your funds. It'd be really good if you had some physical stuff somewhere.
For sure. I mean, just look at Russia right now. People's bank accounts are being canceled. Their credit card isn't good anymore.
Their yachts are being stolen.
Their yachts are being taken. So these are times when the gold that you have stored away safely will be a helpful asset for you and your loved ones and your family, whoever you need to support with your wealth. And these are the four assets of the permanent portfolio.
Is there any other point that needs to go along with this other than the permanent portfolio is great and you highly recommend it? Not being a financial advisor, I might add.
Yeah, no. I don't recommend it. this is what I do.
Okay? That's the way you have to say it. That's right. Yeah. We're just talking about it and we like it. personally.
Right.
So, yeah, is anything else you wanted to add?
Well, only I think there are other portfolios that you can choose to diversify. This is the one I choose. And like I said, the reasons why I like it is because you can have a large gold position with this portfolio, which a lot of other portfolios, they don't really have that. And also a pretty large cash position, which is also pretty unusual for a portfolio. But all of this at 9% per year with a very low standard deviation is incredibly, I haven't found a portfolio that satisfies all my needs
like this one has.
That this portfolio has. And so that's what I do. And I've been happy with it from day one through now. I've been happy with it. It's not all I do. Of course, Harry Browne also talks about your bigger picture strategy, right? You have a core portfolio that is the money that you
have your safe money. Your safe money, right?
Safe money that you don't want to mess around with, your future, your rainy day fund, or if you're saving for a down payment or whatever. This is the money that you don't want to mess with. And then you have a speculative portfolio, which whatever your risk tolerance is, you can allocate your assets to that. I have done cryptocurrency, done very well with that. But when my cryptocurrency allocation goes too high, then I sort of,
so you have an even bigger picture slushing.
Even bigger picture.
Yeah.
But the big picture variation between between the speculative and the core portfolio is an individual decision. It's a psychological decision that you have to make, kind of
what you're comfortable with.
It's much more emotional. People always ask me how much. It's an emotional decision. You have to determine for yourself how much safe money you want. Once you've determined that, then you can sort of start figuring, okay, how much can I gamble? How much can I play around with? How much can I, take real big risks with? But always having your core portfolio as your sort of your pillar of strength that will be there for you no matter what happens, no matter how your speculative investments turn out.
Excellent. So I think we pretty much covered it. So I'll just say this has been Dylan Moore and Nima Major of Irida TV, which you can find at irida.tv, and follow us on the various social media that we have there. You can find it all on the top of the page. And no longer YouTube. We are now in the Cool Kids Club. We've been banned off of YouTube, so high five, Nima, for for that one. And we appreciate you watching, and we'll see you next time.